Okay, thank you very much, everyone, for joining this session, which is a panel organized around like some preliminary results of the OBFA-TRANSFORM project. So we're a Berlin-based research group, and the full name of our project is called The Political Economy of Financing Large-Scale Transformations, Off-Balance Sheet Fiscal Agencies in War, Reconstruction, and the Green Transition. We're hosted at Global Climate Forum and Free University Berlin, funded by Deutsche Forschungsgemeinschaft, DFG. So this is our project website. I just wanted to take like 2 minutes to briefly explain a bit the idea of the project. It should actually come across by scrolling down here. So what we're particularly interested in is in how large-scale transformations can be financed, have been financed, maybe financed in the future. And our definition of large-scale transformations is, well, war finance, reconstruction finance, and then green transition finance as a maybe future, something that might happen in the future. Like a couple of years ago, that was very fashionable as a topic. I feel at the moment it almost became a bit odd, even though obviously no problem is solved whatsoever. And the idea of this research group is to work with some key concepts. So one key concept is this idea of monetary architecture. We look at webs of interlocking balance sheets from the monetary and the fiscal side that we can map for like different periods of time and different countries, or look at cross-country entanglements. And then a big idea is to investigate off-balance sheet fiscal agencies, which is sort of an analytical term that is derived from this. So those are all these sub-balance sheets that somehow belong to the state. In our definition, it's a very wide definition. So sub-balance sheets that belong to the state, but are neither the core treasury nor the central bank. Those can be some special funds, development banks, or whatever you find. And so our research hypothesis is that these OBFAs basically tend to pop up, in particular in the context of large-scale transformations. So whenever states want to finance them, they will find that maybe the existing financial institutions they have are insufficient, so they try to invent new ones. And then what needs to happen, and this is what we try to do, and which is really like the application of the money view, I think, is to use something that we have been calling the macro financial governance process down here, where the idea is, well, you need to expand the balance sheets. You have to worry about funding. You maybe have to worry about backstopping. And then maybe you also want to contract it again. But contraction is then always the big question, right? Should it happen? Does it have to happen? Does it happen? And so we do a bunch of different case studies. We have three country cases. We have the UK, the US, and Germany. And so we had to reach some milestone last fall to sort of get our second funding period approved. So that's why we really made sure to finish a couple of our case studies. And we publish these case studies in our working paper series. So if you go down here, so we can look at our publications. And so we started a working paper series. We're now at volume 14. What we're talking about is a bit like more in the middle. But so we chose 3 case studies that we want to talk about that really apply this idea of a macro financial governance process. And the first one is by Olan about U.S. housing finance, which is connected to a ecosystem of different OBFAs, right, that sort of emerged over like a long period of time. Then the second one will be by Andrei, who will talk about the exchange equalization account, which is an OBFA that we unveiled that the UK used in a very secretive way at the beginning to support World War II finance. And then Verena was supposed to talk about a paper about contraction management of different types of post-World War I debts, but Verena is unfortunately sick. So Armin, who is I think in the call, and I will talk a bit about that paper. Then without further ado, I will pass on the floor to Olan.
Great. Hi, everyone. Morning, afternoon, evening, I guess, to Sasha, who's in Shanghai. I'm just going to share the screen. So now do you see the Is it still in present mode?
No, it works well.
Okay, great. Okay, I'll start then. Hi, everyone. Yeah, I'm Olan. I'm a political economist, and I'm a doctoral researcher based at the Global Climate Forum here in Berlin. I'm working on Stefan's project, as he said. Yeah, and today I'm going to be presenting the first of our case studies. I'm looking at first of our case studies looking at large-scale transformations which happened during the 20th century. So this paper specifically looks at the transformation of US mortgage finance from the Great Depression onwards, and particularly the role of what we call off-balance sheet fiscal agencies, or OBFAs, in this. Right, so I'll jump right into it, and I'll first introduce the idea of the paper to you. So our historical case studies, as Stefan said, look at the financing of war and reconstruction during the 20th century in the United States, the United Kingdom, and Germany. Obviously, the United States stands out here in terms of reconstruction, as they didn't need to reconstruct their economies and physical capital stock in the same way that Germany and the UK did after the war. Therefore, we decided to look back a little bit further and look at the response to the Great Depression. Which led us to this puzzle. How did the US go from being a country where people built shanty towns, they were known as Hoovervilles, named after President Hoover, in order to have a place to live, to a country where suburbanization expanded at a pace never seen before in less than 20 years. So on the next slide, we put this more in terms of the data that we have. So we asked how the US went from the largest housing crash ever seen until that point, which you can see in the data on the left, during the Great Depression, to the unprecedented expansion of home ownership, which you can see on the right, with the home ownership rate increasing by over 20 percentage points between 1940 and 1965. So yeah, that brings us to the research questions which we framed the study with. As Stefan mentioned, our research group asks in general how OBFAs have been used to stimulate historical large-scale transformations. And in this study, we asked three interrelated questions that are related to this. Firstly, we asked how did the private mortgage lenders who were involved in this large-scale transformation expand their lending activities? Secondly, we ask how OBFAs manage this housing finance cycle, particularly considering that the massive expansion of housing didn't result in any system-level financial crisis, as we see with other housing finance cycles throughout history. Thirdly, we ask what were the political and economic foundations of this process. This is the question that I usually focus on when I'm presenting to political scientists. I'm a political scientist myself. But today, as we're here at the MoneyView Symposium, I'll focus more on the first two questions, which are more about the mechanics and the money behind it. Yeah, so our paper is a historical case study which uses primary materials from the institutions which we study, and it also relies on secondary literature. Yeah, so first of all, I think we should go through a little bit what our theory of what happened is. What you can see here is what most studies of large-scale transformations focus on. They're the apex institutions of the state, the central bank, and the treasury. So what we're interested really in here are more the mid-level institutions, which we hypothesize actually do most of the heavy lifting in these transformations, while the apex institutions focus on systemic stability. So OBFAs are then guaranteed by the treasury and provided liquidity by the central bank. But yeah, they're the ones that are actually doing the day-to-day operations, and they're involved with the financiers. So yeah, that brings me to the first element of how OBFAs help to manage this transformation, which involved banks. Banks lent to a wide range of borrowers during this period, who were often riskier than borrowers who went to other financial institutions for mortgages. Therefore, the OBFAs work to de-risk banks' lending activities through insurance and guarantees, while banks funded these OBFAs through fees and through buying their securities, for instance. Yeah, then the second element in this transformation were specialized savings institutions who created deposits to lend to home buyers like banks, but had a much narrower funding basis than banks. They relied on local savers' deposits, which were prone to flee in times of crisis. This meant that the OBFAs focused on the stability of these institutions. They were involved in less risky lending, but they were subject to depositor panic due to their lack of access to systemic liquidity. So then you can see here sorry, I need to go back. These two sorts of lenders were specialized in different segments. Banks were involved in the federally insured mortgage segment, which focused on lower income borrowers. And the SNLs were more involved in conventional mortgages, which were for higher income borrowers. So now I'll take you through our case study. As I said, as I'm presenting to a crowd that are familiar with the money view, I'll present this a little differently than I normally do, and I'll mostly focus on our flowcharts, which tell the story through our idealized version of the balance sheet transactions of these institutions. First of all, this is a timeline of our case study. We focus on 4 stages during the Great Depression and the New Deal, then the early post-war period, after that, the later post-war period, and then the final period of our study in the 70s and early 1980s, in which this housing finance ecosystem, as we call it, began to break down. So first, I think it's important to quickly understand the status quo in the housing market before our case study began. In the 1920s, many mortgage lenders used an instrument called a balloon mortgage. In case people are unfamiliar with this instrument, a balloon mortgage was a mortgage where the borrower only paid the interest over the term of the loan, while the full principal was due at the maturity date. These loans were mostly short-term, with 5 years being a common length. So, in normal times, the borrower could refinance the mortgage at the maturity date, taking out another balloon mortgage with the same lender or another lender if they didn't have the cash ready to pay off the full mortgage. But the problem that we see during the Great Depression is that during a downturn, this was a disaster, basically, because it was pro-cyclical. When borrowers experienced financial pressure and were unable to repay, lenders were unwilling to refinance. And so a large amount of borrowers would default, as we see in the option 3 here. So at the height of the Great Depression in 1932, 1 in every 4 American mortgage borrowers were in default. So that leads us to our first institution that we introduced, which is called the Homeowners Loan Corporation, or HALC. The HALC was a public agency set up by the Roosevelt administration in June 1933, and the idea behind it was to clear the bad debts from the financial system, which were preventing new lending, and to end the foreclosure wave, which was gripping the US. What HALC did was to issue bonds, which would swap with mortgage lenders to purchase their defaulted mortgages, which they held on their balance sheets. 1 second, I'm just trying to go to the next step. There we go. One issue is that the lenders would want to resell these bonds for cash. But due to the panic in the market at the time, HALC bonds weren't trading at par initially. So the federal government was forced to pass an unconditional guarantee of principal and interest and to allow the Fed to buy HALC bonds in April 1934. And after that, the bonds were freely accepted in the market and traded at par. So then in step 3, what you can see is what HALC did was to refinance the mortgages it bought, extending their term to 10 to 15 years, making sure they're a fixed rate mortgage and making the mortgages self-amortizing, which meant that lenders paid off the loans in even monthly payments. So this allowed most borrowers to remain in their property and repay their mortgages over a longer period, with around 85% of borrowers eventually paying off their entire loan. And here you can see the data on the impact of the HALC. So new mortgage lending completely collapsed after 1929, going from almost 5 billion in new loans in that year to around 1.5 billion in 1932 at the height of the Great Depression. HALC did most of its lending in the first year and a half of its existence, lending up to $2 billion in total over its lifetime. And you can really see the impacts there of restarting mortgage lending. But the problem was that the HALC didn't solve the issues faced by lenders who were involved in less risky lending, namely the savings and loan associations that I mentioned earlier. They were small, specialized deposit-taking and mortgage lending institutions which operated like small local banks. So during normal times, SNL's business was stable and safe, but in times of panic, they found themselves cut off from systemic sources of liquidity, not having access to the Fed, and being cut off from interbank lending markets. The Hoover government already set up the FHLBs in 1932 to provide liquidity to the SNLs, which required that the participating institutions bought the stock of the FHLBs. This, therefore, was a private sector institution, which the federal government instructed the SNLs to fund and manage themselves. The FHLBs would issue bonds, which were bought by investors due to their confidence in the support of the federal government for the FHLBs. And here we see an orderly contraction with the borrower repaying the S&L, who in turn repays the FHLB. So this was the regular situation for an S&L during this period, which was a very safe form of lending. So for other lenders, while the Hawk cleared bad loans from their balance sheets, for these lenders who interacted with riskier borrowers, it didn't solve the issue of correcting the failures which had resulted in this crash in the first place. That's where the Federal Housing Administration stepped in. They provided federal insurance, which met certain conditions. They provided federal insurance on mortgages which met certain conditions. This meant that the mortgages would be self-amortizing. They'd have a low interest rate, generally below 5%. But I was informed by Hermann Mark Schwartz, who some of you might know, that his parents received an interest rate of 2% on their FHA-insured mortgage. And the properties would need to meet standards set by the FHA to receive insurance. Mortgages became standardized throughout the country. Beforehand, there would be huge differences in regional mortgage markets. So investors couldn't be sure that a mortgage in Massachusetts was the same as a mortgage in Mississippi. Yeah, let me just go to the next step. Yeah, the standards introduced by the FHA meant that most borrowers could easily pay back their mortgages on time. But in the case where a borrower defaulted, the FHA would either compensate the lender for the difference between the outstanding balance and the amount that they could recoup through foreclosure and selling the property, or in other cases, the FHA would take over the property themselves. So this was the fundamental de-risking of the activities of these lenders. They could rest assured that they could lend to a wide range of borrowers with different risk profiles without the risk of their balance sheets being weighed down by bad loans, as in the Great Depression. And this changed their calculation from how much they could make on any single mortgage to how many mortgages they could sell overall at a guaranteed rate of return. Yeah, so while these mortgages were now standardized and could theoretically be bought and sold across the United States on the secondary market, the market remained practically non-existent at this time. The federal government had tried to create private national mortgage associations by offering federal charters, but due to the impact of the Depression, few financiers had the appetite. That's why the federal government introduced the institution that most of you probably know the best from this case study, Fannie Mae. Fannie Mae would buy any FHA-insured mortgage on the secondary market, meaning that lenders had an additional source of liquidity, reducing their maturity mismatch. Fannie Mae managed the mortgages on their balance sheet until maturity. And in just 1 second, Fannie Mae was massively successful in these operations. Its impact was more about the assurance that lenders had that they could offload mortgages at any time, rather than the actual size of Fannie Mae's balance sheet itself. Nevertheless, fiscal conservatives became more concerned throughout the 1950s and 60s about the costs associated with Fannie Mae. As in years where there was a downturn, Fannie Mae would buy additional mortgages to prop up the mortgage market, and that this cost was on the balance sheet of the federal government. So what they tried to do is they tried to create these participation certificates, which were an early form of mortgage-backed security. This worked for a little bit of time during the 1960s, but in 1968, a presidential commission ruled that the participation certificates were another form of borrowing from Fannie Mae. And this meant that Fannie Mae was eventually privatized to take its expenses off the federal government's budget. Yeah, so in this slide, you can see the data on the impact of what all these institutions did to the US mortgage market in the different phases of our case study. Throughout stages 2 and 3, federally insured mortgages were a large part of financing for mortgages, while you can see on the right-hand side that most of this debt was held by the S&Ls, while the federal agencies such as Fannie Mae constituted a much smaller part, before increasing in the final section as federally insured mortgages became less prominent. I will just skip over these next few slides as I think I've gone a little bit over my time, and I will skip to the conclusion. Yeah, so these are the main points of our paper. So we conceptualize the US housing finance ecosystem that we talk about as a Minskian thwarting mechanism. much focus in the literature at the moment on housing is focused on the US's consumption-driven growth model, which provides a lot of support for borrowers. These are floor mechanisms, and it props up demand. But we found that less attention is paid to the supply side, where the OBFAs provided both the floor and the ceiling mechanisms, which allowed for the orderly expansion of housing during this period, with a massive growth in mortgage debt, but very little financial instability. We find that long-term funding by the OBFAs was freely available, but this came with conditions. So lenders were de-risked, but this came with the condition that they pay attention to the quality of the mortgages. This would be called robust de-risking if people are aware of the framework of Gabor and Brown from their paper from last year. And then finally, at the end of our paper, we focus on the forces of endogenous decay, which explain the end of the ecosystem in the 1970s. I didn't really cover this so much in the flowcharts, but this ecosystem could help to engineer an orderly expansion of housing in the post-war macro-financial regime. But in an era of higher inflation, lower growth, and global capital flows, its mechanisms became ineffective. And then this is my last slide, which basically, you might ask me, okay, that's all very interesting, but why should we care about this case study? So what I think the three main points are that this highlights the relationship between the state and markets in fundamental sectors in market-oriented societies. So it's an example of how more market-oriented states shape markets to achieve major policy aims without displacing the private actors who drive this process. We also highlight in the OBFAs, they're the workhorse balance sheets of the state. They do the heavy lifting in the state's work, while the apex institutions, the treasuries and the central banks, focus on system-level issues and stability. And finally, coming back to our wider research question of our group, large-scale transformations are the order of the day. People are focusing on them from geoeconomic points of view or about the green transition. But we think we still don't really understand past transformations, especially in regards to the money side of it. There are a lot of great historical and sociological studies of 20th century housing finance. Sarah Quinn's American Bonds is one that comes to mind, and Alexander Reisenbichler's Through the Roof. But we found that they tend to underplay the expansion, funding, contraction dynamics, which are characteristic of credit money systems. And thank you very much for listening. I'll pass over now. I'll stop sharing my screen.
Thanks, Olan. So we have Simon, right? Simon Schairer, who was kind enough to agree to discuss this paper. Please, the floor is yours.
Thank you very much. I assume I got like 5 minutes max, right? Okay, great. Okay, first of all, thank you very much for reaching out to me and making me aware of this intriguing piece of research. So I'm always fascinated by balance sheets, and I love playing through how things worked out in detail. So I reached out to you, Olan, beforehand, and you told me about this kind of theoretical angle that you want to strengthen in the paper, also for publication. And so I thought I will focus on that one. So you've mentioned in the very end, there's this late Minskian concept of institutional supercycles, which I find kind of intriguing also because it kind of bridges post-Keynesian money view economics on the one hand with political economy on the other side, which is kind of my background training. And just for those of us who are not so aware of it, it's I think a paper with Minsky himself and Ferry, who I've seen yesterday here also in the call, from 1992, I think. Then Thomas Pally developed it further, and recently then Yanis Dafermos and colleagues worked on it. And I picked up also on that in some research on unconventional monetary policy. And it's super interesting because it thinks of an institutional supercycle that bridges several conventional business cycles that is stabilized by these thwarting mechanisms that basically put a floor and a ceiling to the macrofinancial system and stabilize it. However, just as with business cycles, this Minskian supercycles has its own logic of expansion, maturity, and in the end, crisis moments, which is then followed by perhaps a genesis of a new supercycle. And I think what you do in this paper is, as you say yourself, one long super cycle that you're covering. And I think of course, it's still a working paper, so this analytical lens is still a bit absent from the paper at the present state. But I think what would be super interesting to really decline all the OBFAs that you cover in the paper and see how their role and their functions correspond to floor and ceiling thwarting mechanisms. So I was just thinking, for example, HOLC, Hulk, which I find a great acronym for institution, is to me a typical floor thwarting mechanism, because it used to buy up these balloon mortgages and put a floor under the market in a way by making sure that these borrowers will not default, and this will not lead to an increase in financial instability. Sorry. So on the other hand, you mentioned the FHA, which was insuring a lot of the mortgages. And to me, it's interesting to see that they were having these stipulations on self-amortizing long-term mortgages, which is, of course, a ceiling thwarting mechanism, because it makes sure that there's not instability increasing credit growth in the system. So I think this is something super interesting for the first part of the paper. Whereas the second part of the paper, I think, could profit a lot from the kind of twin concept that unfortunately the Fermus and colleagues dropped in their paper. I don't know why, but both Ferry-Minsky and Pele in 2011, they also work on a counter concept to the typical Minskian financial instability hypothesis concept of financial actors increasing instability via private financial innovation. And the counter side, the flip side, of course, is regulatory relaxation, which is also always a part of the story, and which is where I think the political economy then comes in. Because, of course, it's true, private financial actors do play a big role, and profit-seeking financial innovation does play a big role. But also, as Perry said yesterday, the state also plays a role. And of course, we can tell the story of capitalism from either side. However, I think that in this case, regulatory relaxation definitely also plays a role. And so I think it was Minsky himself already in this paper with Ferry, but then also Pele, developed these three kind of types of regulatory relaxation that can be developed further also in this paper. For example, the first one, regulatory evasion. I mean, obviously, the emergence of Eurodollar markets and early shadow banking institutions such as money market funds did play a role. And they were, in a way, financial innovations that grew in a scope that was not conceived by regulators in the first place. So it's one could say this is regulatory evasion. And of course, it did play a huge role in putting pressure on mortgage finance in the US, especially in the 1970s, when Regulation Q caps on interest rates were in conflict with higher returns in Eurodollar markets for the more larger US banks that had access to London branches. And on the other hand, of course, money market funds that could also siphon off deposits from retail investors who would otherwise perhaps deposit their savings in loan banks, right? So this is like one example where you have this mechanism with a direct relation to your case study. The other one is regulatory capture, which is largely absent from your analysis so far, but I'm pretty sure that there's a huge story to be told about lobbying groups, about business associations and neoliberal think tanks trying to capture regulation and weaken it. I mean, there's a big story about it, and perhaps you shouldn't go into the big picture so much, but I guess there's also a lot to be told with regard to housing finance and its corresponding regulation. And last but not least, what I found super interesting from a political economy, political science perspective, as you said, you're also a political scientist by training, there's this idea of regulatory relapse, which is what we in German call Zeitgeist, like the collectively shared beliefs, tenets, and norms of a certain era. And that memory of past crises is gradually fading and eventually lost, both among private financial actors, but also, crucially, among regulators, politicians, and academics themselves. So each and everyone is captured in his or her own time in place, right? And a bit what also Sven Beckert said yesterday, right? From a historiographic point of view, there's always this context in which a certain thinking is developing and evolving. And I think this might have also played a role in a way in the 70s when the whole thwarting mechanisms were sufficiently deteriorated to put the whole system into crisis. Perhaps it's the most difficult type of regulatory relaxation to demonstrate in the context of your study, but from a discursive or political scientist perspective, I think also perhaps the most interesting. But that might also go just beyond what you're doing in this paper, and I see that. So because this would then kind of become a bit more discourse analysis. Anyways, I'm going to share my notes with you later on per mail. And thanks so much once again for the paper. I'm looking forward to seeing it in its final published version. Thanks.
Thank you so much, Simon. I suggest in the interest of time that we collect a few more comments or questions before giving it back to Olan. Any remarks?
I think maybe we can do some at the end, right? Probably.
Can also collect something at the end. I mean, there was one, so Alex commented in the chat and asked if the thwarting mechanism, so the Sminsky label is the same, what Perry or the Money View crowd would call the outside spread. Maybe Simon, you've published on it. What do you think?
It's an interesting idea. I haven't thought about it, but thanks for pointing out to it. I think not really, because so the thwarting mechanism is conceived to destabilize the macrofinancial system in a way that it does not come to a systemic crisis. And now the way that I understood, at least, Perry's, for example, lecture from 2013 on the outside spread, I would say that this was rather when the systemic crisis happened. So that was when the thwarting mechanisms did already fail. That's when then the outside spread of the Fed was coming in and really saving the system. But it's a super interesting question, I guess. I mean,
I think it's both. Part of the idea with the outside spread is that you set it, and then the market will never hit the outside spread because it knows it's there, right? So maybe there's a little bit of overlap.
Okay.
I see Perry has a hand up. I don't know if there's a. Oh.
Please.
Am I unmuted? Yes, I am unmuted. Okay. So I just wanted to just add the idea that the savings and loan banks created during the Great Depression, which were borrowing short and lending long, were basically destroyed during the 70s when nominal interest rates rose. And they had to compete with the money markets, right? And so they were destroyed and they had to be saved and bailed out. So you're nodding, so you know this. So you didn't mention any of that, but I think that it's maybe important to, this is a macroeconomic aspect, right? That was not, they were invented, this self-amortizing mortgage, as you say, as opposed to the balloon mortgage, was a stabilizing invention, but it was only possible with a government backstop because no one would ever lend me money for 30 years, No bank would ever do that, So this just like student loans. No one would ever lend money to a student unless there was some, guarantee somewhere. So yes, I think this is right that you're on the right track. But then the way this was financed, was borrowing short to lend long, and that was inherently, gonna blow up on you. and it did, and it did. So just to put that in perspective a little bit.
Yeah, thank you for your comment, Perry. I mean, I didn't really get to cover it because I ran out of time a little bit, but we focus in this final part of the case study on the 70s and the early 80s and about the move to securitization and about how the segmentation of the market broke down, right? And the SNLs tried to move into new forms of business and their balance sheets deteriorated and there was this crisis eventually. But yeah, as we conceptualize it, it was that they engaged in forms of lending that were reckless in this era of when the housing finance ecosystem, as we call it, was breaking down. So it was like, I mean, of course, it's already during the 60s, inflation is rising and they come across all these issues. And that's when the regulatory issues that Simone highlighted came into play. And yeah, so that is covered in the paper, probably not to the extent that we should do, but definitely the ideas of bringing more in the idea of borrowing short, lending long would be beneficial to the paper.
So, hi, Minsky. I think it was him. He used to say the savings loan business was a 3-6-3 business, meaning you borrow at 3, you lend at 6, and you're on the golf course by 3 p.m. So it was that's what it was meant to be. And then it when you're not borrowing at 3 anymore, but you still have these mortgages on your balance sheet, it all blow up. So I think that I just remember that 3-6-3. that was the business.
All right, thank you so much. I mean, if there are other comments, please, maybe you can just paste them in the chat because we have 2 more papers to cover. I would now give the floor to Andrei to talk about the exchange equalization account.
Thank you very much. So let me see if I can share this. Always a nerve-wracking moment. Is it going to share or not? There we go.
Success.
Yeah, I think so. Great. So thank you very much. Just a little bit of introduction. You might be seeing a couple of other logos here. There's the University of Bath logo there. So you might be wondering what's up with that. Besides the fact that it's the best place in the world to see Georgian stonework, it's also my home base. So I teach at the University of Bath and I teach international political economy. So this paper is also a little bit more political science-y, I suppose, but I'll mostly focus on the balance sheets here. And as you'll see, our 3 presentations today focus on different countries, and the OBFA-TRANSFORM project itself is mostly focused on the US, the UK, and Germany. And I guess the way we thought about the UK, at least at the beginning, we thought about it as a sort of negative case study, that in the UK, you can't really find as many off-balance sheet fiscal agencies, if any at all, because in the literature, there's always been this idea that the UK is characterized by treasury control. So the idea that the treasury has a much bigger sway on how the budget is spent and a much bigger suspicion of institutions that might be able to overreach or go around the treasury's control. But what we found really is that there are plenty of examples. And one of the best examples really is the exchange equalization account. And the paper today really is about how it's really an institutional biography of the exchange equalization account, which still exists, although it was founded almost 100 years ago. So it was founded in 1932. And what we see is that it was founded as a specific fund with one specific purpose, and then during the war it really expanded and it acquired so many other different purposes that were very, very useful during the Second World War. So with that said, just start, there we go. Yeah, so I think just to position this in the literature a little bit, so we look at the war finance literature, and the war finance literature is quite vast, and it usually is structured around these 3 pillars when it comes to how states actually finance wars. So, you have taxation, borrowing, and money creation. And there is, of course, a profusion of literature that looks at each one of these pillars of war finance with all sorts of insights. So, for instance, when it comes to taxation, there's always the idea there's a sort of mutually reinforcing relationship between the fiscal kind of expansion of states and wars, because wars pose all sorts of pressures on states to raise taxes, and then they develop a fiscal administration. And taxes kind of increase, and yeah, there's a lot of literature on this. But then there's, of course, the literature on borrowing, and I guess here an insight that I want to draw attention to specifically is this idea that there's a sort of advantage to democratic states that have parliaments, because deliberations on borrowing and budgets are much more transparent when it comes to democratic institutions. So this provides some sort of advantage in borrowing, reducing usually sovereign borrowing costs. And this is very, very interesting, because off-balance sheet fiscal agencies, of course, are not necessarily the most transparent institutions, and this will play a pretty important part in the story here as well. And then you have money creation, so just printing money for financing wars. And of course, there's a lot on how this runs into all sorts of limits because of inflationary pressures, etc. So what we notice in this literature is that usually all these kind of scholarship focuses on what we call apex institutions or apex balance sheets, like treasuries and central banks. And on these kind of mechanisms that are transparent, you see them in national accounts, you see them in parliamentary records, in archives, for instance. But this really misses out on the role of OBFAs that don't necessarily appear here, but they rear their head when they need to, right? When states find that they have limits in financing specific public policy objectives, but they have other institutions that they can tap for this as well. So our case study on Britain during the Second World War is kind of the perfect example for this, because all of these three different pillars of war finance were structurally limited to some extent. So we're not claiming that they didn't use. Of course, they did use. Everybody knows that. There was a lot of borrowing, there was taxation, there was money creation. But there was also quite a bit of restraint in each one of these pillars, right? And that's especially because of the First World War, the hangover, the kind of fiscal hangover from the First World War, then the Great Depression itself. So, the debt burden was still quite high. Taxation was already, the tax base was expanded much more than in the past, especially with rearmament since beginning with like 36, 37. There was also a lot of fear about what might happen to inflation as well. So all these three different pillars were to some extent structurally constrained. And on top of this, Britain at the time was still a very open economy. So it relied a lot on imports for its food, for its calories, for instance. I think it was about 70% of its calories used to come from abroad. And also for raw materials to go into industry. And a lot of these were, of course, denominated in sterling, but not all of them. So Britain was always kind of short on foreign exchange. So this forced Treasury officials to ask, what other fiscal resources can we think of that might already still exist within the institutional architecture of the state, but can be deployed without going back to Parliament and having to take, complicated decisions. So this is where our story with the exchange equalization account comes in, established initially in 1932. So this was just 1 year after Britain came off with the gold standard. And it was meant to be initially simply a sort of, to use an anachronistic term, technocratic instrument. It was meant to simply manage the exchange rate. But what we see is that during the Second World War, this was kind of systematically repurposed. And we call this, a form of kind of emergency institutional bricolage. So just a kind of recombination of existing institutional material to produce new kind of outcomes. Okay, so Yeah, I'm going to focus now a little bit on these flowcharts that we have. So, and I'm going to talk about the kind of pre-war design features of the fund itself, and then I'm going to talk about the what changed afterwards. So, initially, the fund was established, as I said, to basically prevent so-called undue fluctuations in sterling, as opposed to so undue fluctuations is, you can find it in the archive. This is what Chancellor Chamberlain said, that the purpose of this fund was to simply deal with fluctuations that are not natural in the value of sterling. Obviously, nobody knows exactly what is naturally or not, but this kind of allowed or afforded the EEA with a sort of discretionary space to use. So the EEA itself was a kind of treasury account, but it was served by the BOE as its operational, the Bank of England as its operational agent. So it was quite remote from Parliament as well. It had a specific degree of operational autonomy as well. And already by September 1939, so in the wake of the war, 10% of GDP was accumulated in this fund. And as we can see from these charts here, it was basically quite successful in managing the value of the exchange rate when Britain came off of the gold standard. We see with brown the French franc, and with blue with the US dollar. And it was initially kind of set up in a lot of secrecy, but of course the US quickly found out about it. And then in 1934, the US set up its own sort of similar fund, Exchange Stabilization Fund, I think it was called, that would serve a similar purpose as well. So the initial pre-war design of the fund itself was pretty simple. It was meant to, sell its assets, which were mainly treasury bills. And, if you had a capital inflow, which resulted in appreciative pressure on sterling, it would sell its treasury bills and you would buy foreign exchange. And this would, of course, protect the value of sterling. And then on the flip side, if you have a capital outflow, it will do pretty much the reverse. Okay, so war comes, and the EEA is basically completely repurposed with the defense finance regulations. Its statutory ceiling, which I think it was about 150 million pounds, is completely abolished, and then it's authorized to be used as an expedient for national defense. Basically, use any sort of means necessary to kind of advance the policy of the state. And we divide these powers that it acquires in three. So this is the first one, asset requisitioning. The next one is about international operations, and the final one is about lending. So I'll quickly run you through all these three different powers that it acquires. So asset requisitioning was really something that affected all the kind of assets that existed, or a subset of assets, let's say, that existed in Britain at that point. First of all was foreign currency securities. So these were simply the people that own foreign currency securities had to sell them to the exchange equalization account in exchange for market prices, but obviously market prices that were set by the EEA itself. So as we can see in this flowchart here, basically anyone who would have a British resident, let's say, had a foreign currency, it would sell this foreign currency, it would be obliged to sell this foreign currency to the EEA, and in return, it would get sterling deposits. And then the EEA had all sorts of things that it could do with this. It used it for various purposes. You could sell it for British pounds, or you could use it to fulfill your foreign currency needs as well. The second instrument was blocking regulation. So this affected foreign owners of British securities denominated in sterling. So they would be simply blocked. And they would not be able to withdraw, to exchange them for foreign currency, because they wanted to conserve hard currency itself. So they would have to basically give them up to the exchange equalization account, and the exchange equalization account would issue a claim for blocked sterling that they could redeem at some point in the future. The second set of powers had to do with Britain's international operations, specifically with trade. So a lot of countries had trade surpluses with the UK for a variety of reasons, not least because, as I said, the UK used to import a lot of its food and a lot of its raw materials for its industry. So what it did was, as soon as one of these countries would have a trade surplus, this trade surplus would be deposited into a special account at the exchange equalization account, and it would be kept there in sterling, basically. So the British the British importer, the foreign exporter, sorry, would get essentially a claim from the EEA that it would have these sterling assets basically locked into the exchange equalization account. For the US and Switzerland, there was a sort of a different mechanism, because the US and Switzerland were allowed to convert their foreign currency, but they would have to route this conversion through the exchange equalization account as well. So they would have to sell Swiss francs and US dollars there, or rather sterling there, and then they would receive foreign currency at a pre-established rate by the exchange equalization account. And well, because the exchange equalization account found itself having all this sterling deposits on its books that were essentially claimed to foreign exporters, it also started engaging in foreign exchange transactions, so that it would it would essentially act as a forex trader as well, so that it would guarantee the price of guarantee the exchange rate of foreign currencies for all of these foreign owners of its securities. Now, so yeah, the EEA accumulated all of these sterling balances, and they didn't just sit there, right? So Britain started using these for various purposes. Of course, because the EEA did not necessarily have to report its holdings, it only did so with a lag of 3 months and only a couple of times a year. So there was not a lot of transparency. So Britain really started using these for all sorts of purposes that were useful for itself, like paying for imports, for instance. But also it started acting as a sort of a ledger, and it started managing other countries' trade surpluses and deficits. So if some countries would have trade deficits with the UK and would not be able to fund them, then the UK would simply transfer surpluses from one account to another, acting as a sort of a international monetary fund in a sense. And there's this very small graph here that is meant to show you how the UK accumulated all of these net external liabilities. So that's during the Second World War, from the 1940s, from 1939, 1940 onwards, with blue. So those are its net external liabilities, whereas the rest that you see there is the foreign currency that it used to have as its assets. So it started using these for its own sort of purposes. And the last set of powers that it had was the power to essentially lend. Now, the problem was that Britain decided that it's going to keep its interest rate at 3%. It's going to wage a 3% war, but obviously this was very, very difficult to find a lot of supply for capital at 3% in those contexts. And we see this, that in early 1940, it starts issuing a national war bond. It really underperforms. It doesn't have a lot of subscribers. So there's a very funny story in which the Bank of England basically secretly buys this, pretending to be a sort of different kind of external investor. So the EEA steps in. It becomes the primary deficit funder. It starts buying treasury bills and essentially funding the treasury itself. And furthermore, when it stops doing that, then it when the reserves kind of run out, then it goes abroad, it goes to the US, and it uses some of these foreign exchange reserves that it had as collateral. It gets a loan from the US Reconstruction Finance Corporation, then also another one from Canada, 700 million Canadian dollars, using all these vested foreign securities as collateral. So just to give you an impression of the sort of scale of the operation, it vested more than 300 million pounds in hard currency from owners of foreign assets in the UK. It became the primary deficit funder in 1940 of the Treasury, with almost £500 million, with more than £500 million. It already, throughout the war, it already owned a third to a half of all of the outstanding Treasury bills. So that's basically more than $1 billion. And yeah, this is just to kind of conclude a little bit. In the paper, we make a lot of sort of claims and contribution to the political science literature, mostly having to do with the fact that, you know, this usual tripartite way of understanding war finance undercounts the fiscal resources of states. And if you look at the EEA as an OBFA, then you are, yeah, it's pretty visible. Yeah, I'm going to skip the other contributions to the political science literature, but yeah, I hope that it kind of, the balance sheets kind of gave a pretty clear impression of how the EEA operated during this time. So thank you.
Thank you so much, Andrei. So we pass on the floor to Lara Merling to discuss this paper. Thank you very much for your time and agreeing to read it, Lara.
Hey, thank you, and it's nice to see some familiar faces, and hello from London now, where I'm now working at UCL on industrial strategy, but really the question of financing industrial strategy in the global south. So that's kind of the lens through which I looked at this paper, and I thought it was extremely kind of interesting and relevant to so many of the debates that we see today and like in these areas, and kind of thought of it around like 3 areas, you know, there on the questions of like, you know, financial openness and stability, the institutional foundations of fiscal space and fiscal capacity, and just the general debate on asymmetries in the world of like who is able to have this kind of like institutional arrangement and who isn't. And like when I say, you know, to start with, like, one, the financial openness thing of it's now so ingrained that you know, shouldn't manage your capital flows. Maybe there's been some like movement in the literature there, but it's still like in a lot of like institutional arrangements, investment agreements, that you shouldn't be doing anything and you should have capital account liberalization. And that's like the way to attract investment and grow. And it's such a, you know, like good to bring this like lessons back from history that actually like the success stories of having like a currency you've like stabilized are through this kind of interventions. And it's like not the other way around. And, you know, how do we then eventually like bring these lessons back to like policy and like doing things that way? And even there, it's like interesting to hear how like this was being done in like a hidden way, even back then. But now it probably would be much harder to do this, even like trying to do it in like a hidden way. And like this, like there's so many like arrangements, like investment agreements, trade agreements, and rules that like don't let you have this type of intervention. And then kind of also going back on like this mechanics and like domestic fiscal space too, and how I think just like the connection between also like having just overall like stability in like your currency, but also like an institutional architecture that can expand fiscal capacity. And it's not something that's like fixed or given. And, you know, we see it in the war like context, that kind of like, I don't, like a bit of the cliche of like, when there's a will, there's a way. And like, why do we have this will like during wartime, but we don't have it, you know, to finance the green transition or these other things that we kind of recognize are important? but we're not like doing the same like arrangements. And again, we keep having this like mainstream like economic orthodoxy like ingrained. It's like ingrained in like the UK and EU legislation, and then also like for like countries in like the South that rely on the IMF and so on, that fiscal space is like a fixed constraint, and like we like don't discuss like the arrangement that you can have to expand it, and like how do you expand it productively, and how do you like spend more but also make sure that like what you're spending on is like productive. And kind of like then the third area of like the symmetries, it's like interesting to me to also like read how like these arrangements were like helping and helped like the sterling maintain a position that maybe it otherwise like wouldn't have had. But it's also like this type of like administrative control was feasible to begin with because the sterling was in a central position. So it's like, what does it also mean for countries that are like not at the apex and like are at the bottom of these hierarchies, and like what can they do to like maintain their like, stability? And I think that's where I'm going to leave it. And
thank you so much. I mean, we're very much under time pressure, but still I wanted to ask if anybody has comments. Maybe you can like just give some very quick comments on that paper. It would be really nice for us to collect them. Yeah, Perry, please.
Yes. So I quickly, because I see the time, I just want to underline what you said about the exchange equalization account was created in 1932. Okay. After the sterling came off of gold, as you say, but let's just underline that more, that the world was on a sterling standard. And this was the end of the sterling standard. And there was a huge sterling overhang because many countries had sterling balances. And so this was a huge problem because they wanted to convert them into dollars, not immediately, but over the 30s. And so I would just bring that into the story a little bit. Okay. The second thing is, Zielinski Capella. So monetary. So I don't know if this was true of Britain, but it was certainly true of the United States in war finance, that the role of the Fed, that basically the United States borrowed, as much as it could. It issued bonds, but if you couldn't sell the bonds, you basically forced the banking system to buy them. And the Fed supported that. So it was it was a temporary thing. This is a way of distributing the bonds. You first issue money and then you sell those bonds over time. So I would just add that little aspect to it as well, that this is not actually monetary financing. You were mentioning, inflation and so forth. This is actually just market making, using the banking system to support war finance. Okay. And you mentioned my colleague Zielinski Capella. I mean, she doesn't understand that. So I have tried to explain that to her, and she doesn't like that. So but this is about supporting the bond market, right? Using the banking system to support the bond market temporarily, until you can distribute the bonds. That's the idea. Jane DiResta, by the way, is maybe a source that you should look into for understanding U.S. war finance. You don't mention Keynes' How to Pay for the War, which is really about taxation more than it is about bond finance. But this is a wonderful. I didn't even know there was an exchange equalization account in Britain. So thank you very much.
I mean, this is something that I think there's just a huge research gap about the EA, right? I mean, we found this all in the archives, and we were very surprised when we saw the extent to which it actually. we were really surprised about the extent to which it financed just like treasury debt from the UK Treasury. So yeah, so we're trying to
excellent
expand on this. Is there any other very quick comment? Very quick. Otherwise, I just go to the third presentation and maybe I just do this. So the third presentation was supposed to be done by Verena, but she unfortunately got sick. We agreed that I would take over, but I would also like keep it short. Armin is in the call, who is sort of the first author also. So I'll keep it very quick and pass it on to Sam then, who has kindly agreed to be the discussant. So this is the third paper, which is sort of about Germany, but also still connected to the US and the UK. And it's about the question of how to contract balance sheets, right? So the other two stories were more about expanding it. This paper is called Après le Déluge, Managing Balance Sheet Contraction After the First World War. Déluge here is this unprecedented volume of indebtedness that was created. And we were asking, so, because one of the big questions is also, I mean, we have all this debt in the system. How does it ever disappear? Can we get rid of it? Should we get rid of it? And so we thought that if we look at war finance, we can just try to understand how it has been done. We use the concept of contraction management here. And we look at three types of debt. We look at German domestic war debts. Then we look at the reparation debts, which were sort of artificially, if you want, created with the Versailles Treaty, and then the inter-allied war debts. So that was basically the US lent to all the allies, the UK also lent to allies, but the UK also borrowed from the US, and there were all these like complex debt interconnections that then were also connected to the reparations debt of Germany, right? So that's why we decided we had to also go cross-country, because this whole debt edifice was sort of inherently connected. And so we wanted to understand, so how did the system actually contract? And we played around a lot with this paper, and we decided to introduce 4 analytical contraction types. And I would be really curious if what you think about these contraction types. But so we say there's type 1 is contraction by fulfillment, that you just repay it. The second type is that you contract by cancellation, so that you write it off, either you agree on it or just somebody defaults. But yeah, so cancellation is one form of contraction. Then the third one is contraction by oblivion. So you just forget about it, you move on. And we decided to conceptualize it as sort of shifting these debts off balance sheet. And then the last one is contraction by redenomination. So you sort of change the unit of account, and like that you reduce the debt burden. And so just the very high level story that we're telling is that, so all 3 types of debt we're looking at, the initial expectation was that there would be contraction by fulfillment. So it's repaid, but that didn't work. So what happened and then there were different stages after the Treaty of Versailles and how to handle it. And like each of the 3 debts basically settled on a different contraction type. So German domestic war debts couldn't be like contracted by fulfillment. And then during the Weimar hyperinflation, there was a currency reform done from the Mark to the Reichsmark, which was basically a contraction by redenomination. Then German reparation debts were finally cancelled. So initially the idea was they would be fulfilled. Then there were different strategies to keep on funding them. But basically after 29, the Young Plan, there was a contraction by cancellation. It was planned partial, but unplanned, it then happened entirely in the Great Depression. And then the inter-allied war debts, we have also 3 stages, where the first one was an expected contraction by fulfillment. Then there were funding agreements concluded throughout the 1920s, when there was a partial contraction by cancellation agreed. But then as the Great Depression hit, we identify what happened was basically a contraction by oblivion. So problems changed, countries moved on, and so these inter-allied war debts were actually never really repaid. We can go very much into detail with this, but in the interest of time, I just want to show our like conceptualization of these contraction types. So contraction by fulfillment, we have a creditor bank and a debtor. They swap IOUs, loan versus deposits. The fulfillment is that the swap of IOUs is entirely reverted. So we have minuses everywhere. The cancellation, then we decided to conceptualize as well, we expand, but then we have minus loan for the creditor, but it cuts into the equity of the creditor and the debtor, which can be, as I said, like conflictuous or agreed upon. And then the contraction by oblivion. We were like playing around quite a bit with it, how to conceptualize this, but we again have sort of the loan versus deposit by a creditor bank with a debtor. And then that was our best idea how to position it. So we just shifted somewhere off the balance sheet and we just stopped talking about it, and continues to exist, but it's sort of no longer present. And then contraction by redenomination, which is what happened to the German domestic war debts, is that you really change the loan denominated in an outgoing currency into an incoming currency, and this is the way how you manage to decrease the debt burden. I have more slides, so we have like data on this, we have sort of the balance sheets where we explain how this works, but since we're really running out of time, I think I showed the high-level idea of it, right? So these 4 contraction types that were applied to 3 different types of post-World War I debts. And maybe I pass on the floor then to, sorry, I just really rushed through this, to Sam to give feedback, because you have actually read the paper. Thank you so much.
Great. Thank you, Stefan. So first of all, I just want to say thank you so much. I really appreciate the effort and the incredible attention to detail that you and your team have put in this paper. As usual, your empirical work is just incredible. These case studies really show the value of looking at these historical events through the lens of interlocking balance sheets, like seeing exactly how German domestic debt, reparation debt, and the inter-allied World War I debts all chain together across borders. So I'm going to keep my comments brief, but I do want to talk to 4 specific points. 1, the balance sheets themselves, 2, your typology, 3, about the ideal contraction, and 4th, about these playbooks and what we can do with them. So to the first point about balance sheets, I have to say that it was tremendously valuable to see the T accounts actually worked out. I've read a lot about sovereign debt liquidations, and I sometimes struggle to fully wrap my mind around what's going on, mechanically when I'm reading the prose. And your visualizations were so intuitive that I actually started reading them before the prose. And they told me a lot of the story, what I needed to know, which made the reading text so much easier, which I thought was a real validation of using visuals and balance sheets the way that you are. And seeing those balance sheets also helped me realize that my struggles aren't isolated, right? So you yourselves highlight the challenge of perfectly representing what was happening, like having to put the word equity in quotes on the asset side of state balance sheets, or having off balance sheets, right? And you explicitly describe contraction by oblivion, as a fundamentally political approach that escapes a more straightforward financial logic. And that raised a question for me, which is, since balance sheets, in this community, particularly here, the money view, are considered these, inherently self-referential mechanical calculators where a change in one has to be matched somewhere else. What does it mean that in reality, states seem to be able to override this, right? I'm reminded, and it seems do so quite regularly in some ways, right? And so I'm reminded of a book about the Chinese banking system, where a government official is asked how they regularly make unpayable municipal debt simply disappear, presumably without harming creditors somewhere else in the balance sheets. And he just shrugs and says, we can do that over here, right? So again, it makes me wonder if our conception of balance sheets as these fully self-referential kind of iron law of accounting can coexist with the idea that balance sheets are ultimately reflections of what is politically supported. Should we maybe be flipping around, our conception of what balance sheets are? The second point is about your typology. I really appreciated the 4-part framework, and that you laid out for the contractions: fulfillment, cancellation, oblivion, and redenomination. I think it's an incredibly helpful framework, and I'll be keeping it in my mind for a long time. Building on it, I had a question after reading your footnote on about France and Belgium. You mentioned that they reduced their World War I debt burdens by almost the same amounts as Germany did through inflation, but they did it through creeping inflation rather than a sudden hyperinflation and a formal redenomination. So I was wondering how creeping inflation fits into your typology alongside the others. Is it a fifth type, or is it that Germany's hyperinflation then redenomination is just kind of an extreme special case of that same inflationary contraction mechanism? And I know there's a whole nominal versus real thing, but the general idea I'd like to hear your thoughts about. And then speaking of contractions, you write in the paper that that ideally a contraction reverts the initial balance sheet expansion and returns the credit system to its initial state, right? Noting that this rarely happens because it's so difficult to do in an orderly way. And I completely agree that orderly contractions rarely happen. And at the same time, I would love to look deeper into that diagnosis, that the reason is simply that it's difficult, right? I think it invites me to question what is ideal in the first place, right? Like, what if and I know this is something people discuss, but what if the initial expansion unlocked underemployed labor, resources, creativity, generating real production that now, requires a permanently larger amount of liquidity to transact, right? In a case like that, we might ask, who would be ideal for, to have a contraction? And you hinted at this a minute ago, Stefan, in your comments on an earlier paper. But it just made me really think, like, looking at these balance sheets, like the income earners and producers surely wouldn't want a contraction. And the creditors themselves would usually rather roll it over. The state definitely doesn't want to pay it back. So perhaps this ideal contraction reflects, the specific ideal of, I don't know, orthodox central bankers. But it just struck me over and over again how profoundly it seemed to be driven by the quantity theory of money. It just felt like everybody was bumping up constantly against the quantity theory of money and the inflation fear. And so just, that relationship between the ideal and satisfying this theory, which is contested, just really stood out to me. So finally, just quickly, I want to say that I want to zoom out to your broader work and what I'm calling the playbooks that you're developing. So you're doing these case studies that are giving us these historical playbooks, the playbooks that were actually run, right? And then in the South Africa paper that you presented yesterday, you gave a forward-looking playbook, and in the green transition work you're doing as well. And I just want to say that one thing I really enjoy about your work is just that I'm seeing thinking that I'm not seeing anywhere else. You're really doing some fresh thinking. It's awesome. And so I'm curious what it would look like to use the knowledge that you developed to develop playbooks completely in reverse. So future-looking playbooks, but in the reverse. Let me give you an example. So beginning with the end in mind, let's take South Africa as an example, where we know extreme wealth disparities persist on household balance sheets. And let's say that the government has a firm goal that by 2030, the median Black South African household and the median white South African household must have equal wealth, right? So if the president of South Africa turned to your team and said, could you reverse engineer all the possible balance sheet pathways that could get us there by 2030? Could you do that? And then if they said, now rate them by criteria like fairness, speed, political acceptability, and put them together into 4 playbook options for me to choose from. Could you do that? And just looking at your work, I feel like you can. And I haven't read all of your papers, so maybe you've already done it that way. But I see many proposals that kind of play out from where we are into the future. And it just seems to me like you might have the opportunity to actually work backwards really exactingly from a desired future to the present versus kind of working out from what we have now, like the South Africa, where the South Africa paper kind of says, here's some places where we could get additional elasticity, and we think that that would help with the balance sheets of households. What if you actually started with the balance sheets of households that need to exist in the future and work backwards and show pathways that absolutely will get there? Okay, assuming they're politically, implementable. I'll stop with that.
Thank you so much. Since I have right now the double function of presenter and chair, and we are basically already now cutting into the next session, but we started 10 minutes late. Maybe let's take 3-4 more minutes and collect some more feedback. Perry, please. You are muted.
Let me apologize to Ulrich, who is being delayed by my comments here. So there's another way. You have 4 categories of repayment. There's another one, which is forbearance, which is that you don't repay, right? That you just sort of carry it on. And I think that's in general what big debts are never repaid, And so I would suggest you mentioned the Young Plan, okay, but before that was the Dawes Plan. So basically, there was the United States capital markets, lent money to Germany so that they could pay their reparations to England, which could then pay the Allied war debts to the United States. So that was the system, and that's just basically forbearance, hoping that eventually maybe you'll repay, but that was not it. There was no repayment. Actually, the U.S. gave the money to Germany that they then got back from England. So I would just add that into your story. I think your story is great. There's really very fascinating information here. So this isn't really a criticism. It's an addition.
Thank you. Any other comment? Then just very quick answers. So Perry, yes. I think we see this. We say that the contraction rarely happens. Usually the system remains sort of in the funding or forbearance, as you call it. So, but we wanted to find the cases of when the contraction actually happens and how it's organized. And that's why we picked this particular case, because we saw that there were all these political negotiations going on. Sam, thanks. Those were all really great comments. Your last one is about, can we flip this around and become forward-looking? I guess this is exactly what this research project is trying to do, what that we're doing all together, right? So this panel was about this historical output, and we're now basically reaching halftime of the project, and we now have to sort of think, how can we extrapolate this, not from backwards to today, but forward. It's not easy, and it's not that I can tell you how it works, but I'm happy to continue the conversation about it because you seem to have very specific ideas, and it's great. And 2 more comments, just so one was about the objectivity of debt, right? This is something we also saw here, that if all these debts existed really is a big question, particular with these reparation debts, right? I didn't zoom into this, but the German reparation debts were structured into so-called A bonds, B bonds, and C bonds. The A bonds were to compensate for direct civilian war damage, the B bonds for war debt that Allied victors owed to the US. And then the C bonds were there just to make the bill much higher. So they were not connected to anything really. And what was said is, so that's the lore that we read, right? So that during the Versailles negotiations, they even said that the Allies said, okay, we need to have a really high sum to cater to our domestic audiences, but we will drop the C bonds, so you will never have to pay them. So is this now objectively existing debt or not, right? In particular, if it's so artificially created. And so all the debates about also Keynes' economic consequences of the peace. So, is this reparation debt really there or not, right? And if you try to really map it with the balance sheets, it gets very, very difficult. And I mean, yeah, at the end of the day, I mean, yeah, the question is, what is the objectivity of all those balance sheets? And finally, you were talking about inflation as a contraction type, and in this typology that we chose, we actively decided not to say that inflation is a contraction in itself, even though this is how it's usually framed around the Weimar hyperinflation, but we said it's the redenomination that is the contraction. But this is also, I mean, so this is the first time we, I think, really discussed this typology, and maybe, so it's work in progress. I'm very happy to get more feedback on this also at a later point in time. And with that, I think we should stop here.
Can
Yes?
I just